Welcome back to my channel once again. I am so delighted to welcome you once again to my channel. In today's video, I'm going to be sharing with you a simple but mind-blowing trading strategy that can generate money for you in the forex market. In my previous video, I talked about how you can combine the bearish engulfing pattern and the shooting star together to get a sniper entry. But in today's video, we are going to be looking at the bullish engulfing pattern and the hammer for you to get a sniper entry. The bullish engulfing pattern and the hammer are both a bullish reversal pattern, right? They act the same, but they are being looked at a different time frame. For instance, in a lower time frame, you can get the bullish engulfing pattern, while in a higher time frame, you can get the hammer. Both of them act as a bullish reversal pattern. Let's say, for instance, if the price has been in a downtrend for a long time and the price now gets to a support level, right? We should know that when price gets to a support level, what happens is that the buyers will step in to push the price up. So once a price gets to a support level and you identify a bullish engulfing pattern at a support level acts as an area of value. So what do? You know that the buyers have stepped in and they are going to push the price up. Or if a price gets to an area of value, right? If a downtrend gets to a support level and you see a hammer at the support level, it means that the buyers have stepped into the market. It means that the sellers are weak. They cannot push the price any further, right? And the buyers have stepped into the market and they are going to push the price up. So that is why I keep saying that the bullish engulfing pattern and the hammer are the best reversal pattern, the best bullish reversal candlestick pattern. So if you can be able to identify these two patterns on a chart, especially at an area of value, it will give you a high probability trading setup, right? So that is why in today's video I'm going to be showing you how you can easily identify a bullish engulfing pattern and a hammer in a chart for you to know when a downtrend is over and when a new uptrend is about to begin. Like I said in my previous video, whenever you are trading the market, always make use of different time frame, right? You can make use of the 1 hour and the 4 hour time frame, right? Because if a movement in a 1 hour time frame is the same in a 4 hour time frame, you confirm the directional movement of the market, right? That is why it is always recommended that you use different time frame to confirm the directional movement of a particular market or a particular pair. Now I'm going to show you a practical example of what I'm talking about for you to understand how this candlestick pattern work. And like I said, candlestick pattern was invented by the Japanese, and it is one of the best way to read price chart, right? It's one of the best way to read price chart, right? It's a price action technical analysis where you read the naked price chart to see what the market is actually doing. So if you understand and knows how to read a price candlestick chart, you will be able to know when to place a trade. You'll be able to get a sniper entry, right? So that is why in today's video I want to make everything simple for you guys to understand how these two powerful bullish reversal candlestick pattern works, so that you can be able to replicate what you have learned in this video in your trading career. So like I say, make sure you backtest whatever strategy that I'm teaching you on a demo account to be able to trade it profitably. So I'm going to share with you an example of how a bullish engulfing pattern looks like. Now if you look clearly on this chart, this is what we call a bullish engulfing pattern, right? This is what we call a bullish engulfing pattern. You can see that the green candlestick is larger than the red candlestick, right? That is why we call it the bullish engulfing pattern, because the bullish, which is this green candlestick, engulfs above the red, right, which is the bearish candlestick. So that's why they call it the bullish engulfing pattern. So when you identify this candlestick pattern at an area of value, what do I mean by an area of value? An area of value can be a support level, right? Like, let's say the market has been trending down, right, forming this red consecutively or consistently, forming this red, right? You can see the market going down, forming this red, right? Then suddenly the market now approach a support level, right? Instead of forming another red, what happened? The price now formed this big green candle, and this big green candle engulfs this previous red. This means that the price have changed momentum, right? It means that the selling momentum is weak and the buying momentum has become huge, right? It tells you that the buyers have stepped into the market. So once you identify this at a lower time frame, then at a higher time frame you can easily identify the hammer. So that is why I say the bullish engulfing pattern and the hammer work the same, just that you can identify them at a different time frame. So if you watch, you see that the market has been going down. Let's say the market opened here. This is where the market opened, went a little bit up, and then went down, went below, and then closes here, right? So when the price closes here, what happened? The market opened here. The sellers now push the market a little bit down here, and what happened? The buyers now step in, push the price up, up, up until the price engulfs above the red candle, right? You can see that the price went all the way to this point and then closes here, right? You can clearly see that the green candle is larger, taller than the red candle. This is what we mean by the bullish engulfing pattern. It tells you a change of momentum from a selling to buying. It tells you that the sellers have become weak and the buyers have entered the market. So that is what I call it, the bullish engulfing pattern. Now let me give you another example for you to see what I'm talking about. So this is another example of how a bullish engulfing pattern looks like. You can clearly see that the market was previously in a downtrend, right? You can see these big red candles, right? The market was previously in a downtrend, and this point might act as a support level because the candlestick pattern always work at an area of value, right? If it's in a downtrend, it works at a support level, but if it's an uptrend, it works at the resistance level. So it always works at an area of value, right? That is where it works. And also bear it in mind that it depends, right? It depends. The candlestick pattern can also work at a dynamic support and resistance level. So what do I mean by dynamic? Dynamic can mean a trend line or the moving average. You can still get the candlestick pattern, that is the bullish engulfing pattern, at the trend line or at the moving average, right? So that's why I said you can get it at an area of value. That is where it becomes highly reliable. If you get it at an area of value, it becomes highly reliable. So you can clearly see that the price was going down. You can see this big red candle, right? So the price now got to this point. This point may act as an area of value, right? This level might be a support level, right? And for you to trade a reversal, you need to wait for a reversal candlestick, because if there is no reversal candlestick, it means that the downtrend will break the support level, right? So it is when you discover a reversal candlestick pattern that you now know that the candles is going to reverse, or that the price is going to reverse. So now the downtrend now went to this support level, and what happened? You now get this big green candle, right? So this big green candles now engulfs above this first red candle. It tells you that there is a buying pressure in the market, that the trend have reversed from a downtrend to an uptrend. The buyers have stepped into the market and they are going to push the price. So what you simply do is you wait for the green candlestick to close, and then you can now place your buy trade, right, and ride the trend. Let me give you a clean example for you to understand what I'm talking about. Now this is a dynamic support level. You can clearly see that the market is in an uptrend, right? The market is clearly in an uptrend because the price has been respecting the moving average, right? So you can clearly see that the price is respecting the moving average because the price is getting up. So if you don't want to make mistake, you need to wait for this candlestick pattern to form for you to confirm that the price is still respecting the moving average, right? Because if it doesn't form, the price might break below the moving average, and once a price breaks below the moving average, it means that the trend have changed. But for the fact that the price has been respecting this moving average, it means that the uptrend is still in progress, right? This blue line is the moving average, right? So you can clearly see that the price is respecting the moving average. So this is what we call a bullish engulfing pattern, right? You can see that the price made a retracement to the moving average, and what happened? You can now see this green candle. This green candle now engulfs above this red candle, telling you that the buyers are still active in the market. So you can clearly see the selling pressure from here, right? You can clearly see the selling pressure from here. So once the price now gets to the moving average, then what happened? The buyer step in. That is why you got this huge green candle. You can clearly see that this green candle engulfs above this red candle. It now tells you that the buyers are still intact, they are still in the market. So you can simply wait for this green candlestick to close. You place your buy trade and your stop loss below the moving average, right? And then you can be able to ride the trend. Your take profit can be 1 to 3 risk reward, or you can ride the trend if you wish to. You can ride the trend and close your trade once the price breaks below the moving average, right? So this is another example of a bullish engulfing pattern, right? You can see that the price made a retracement again, right? You can see this 4 red candle, right? This is a strong bearish momentum, right? The sellers push the price down to the moving average, right? You can clearly see that they push the price all the way to the moving average, and what happened? The price breaks below it and ended up with a wick, right? So what happened again? The buyers now step in and push the price to the extent that the price engulfs above this red, telling you that the buying pressure is still there, telling you that the buyers are still active in the market. So what you simply do is you wait for this green candlestick to close and you place your buy trade, and your stop loss will be below the moving average, and you'll be able to ride this trend, right? Like I said, your take profits can be 1 to 2 or 1 to 3 risk reward ratio, right? So this is how the bullish engulfing pattern works. This is another example of the bullish engulfing pattern. You can clearly see that the market is in an uptrend, and what happened? The price makes a retracement to the trend line, right? The previous one was a moving average, but this time around we are using the trend line as an area of value. So the trend line is now acting as a support level where price could not break below, right? So, and like I said, the candlestick pattern always work very well at an area of value. An area of value can either be a support level or a resistance level, right? So you can use a trend line to identify a support level at an uptrend, or you can use a moving average to identify a support level in an uptrend, right? So here you can clearly see that the price is respecting the trend line, right, telling you that the uptrend is still in progress. So if you really want to have a sniper entry, you need to work with the candlestick pattern. So you can clearly see the price make an up move and then made a retracement, right? And then when the price got to the trend line, then what happened? The buyer step in again and then push the price all the way to this point, right? You can clearly see this big green candle. This is what we call the bullish engulfing pattern. You can clearly see how the green candle engulfs above the red candle, telling you that the buyers are still active in the market. So what you simply do is you wait for this green candlestick to close, and then you place your buy trade, and your stop loss will be below the trend line. Then you can be able to ride this massive trend. And like I said, your take profit can be 1 to 2 risk reward or 1 to 3 risk reward, or you can hold onto your trade until the price breaks below the trend line, right? If you truly want to ride the trend. So this is how you simply identify a bullish engulfing pattern and knows when a trend is about to reverse. Because if this is a daily time frame, this small retracement can be a down move in a lower time frame. If this is a daily time frame, this small move. This retracement can be a strong downtrend in a lower time frame, like 1 hour time frame, right? If this is a daily time frame, right? So that is why I say it's a reversal pattern, because some people are trading the higher time frame while some are trading the lower time frame, right? So if you identify this at a higher time frame, know fully well that this retracement at a higher time frame can be a strong down move at a lower time frame. So that is why we say you use the candlestick pattern to identify reversal of price, to know when price is about to reverse. So once you identify this candlestick pattern, this bullish engulfing pattern, it tells you that the buyers are still active and they are going to push the price higher. So what happened? You can clearly see after the bullish engulfing pattern was formed, the buyers pushed the price all the way to this point. You can clearly see that the price went above this previous high, right, before it made another retracement. So this is how you trade the bullish engulfing pattern. So the second one we have here is what we call the hammer. The second one we have here is what we call the hammer. The hammer is another bullish reversal pattern, right? So like I say, the hammer is being formed at a higher time frame, while the bullish engulfing pattern is formed at a lower time frame. So this is a hammer. This is how a hammer looks like. You can clearly see the rejection, right? You can clearly see the rejection. This is a selling rejection, right? Because the price was previously in a downtrend, right, and then got to this point. What happened? You can clearly see that the buyers push the price all the way to this point, and the price closes here. So this is why we call it hammer. It looks like a hammer, right? A hammer candlestick pattern looks like a hammer. So it tells you that the buyers are still active in the market and they are going to push the price up. So whenever you discover a hammer at an area of value at a support level, it tells you that the buyers are strong, the buyers are active in the market. Let me give you another example of how a hammer looks like. This is another example of how a hammer looks like, right? It can either be green or red, right? But what happened is that hammer is being formed at a support level. So whenever you see a hammer at a support level, it means that the trend is going to reverse from a downtrend to an uptrend, right? Because previously the price was in a downtrend, and what happened? The seller pushed the price all the way to this low, right? The sellers pushed the price all the way to this low, and what happened? The buyer step in and then push the price up till the price closes above here, right? The price open here. This is where the price open, and the sellers push the price all the way to this low, right? And what happened? The buyer step in and then push the price all the way to this point till the price close above this point. So it tells you that the buyers have stepped into the market and the sellers are weak. So it means that the buyers are active and the sellers are weak. So you only look at the hammer at an area of value, which is the support level. So this is what I'm talking about. This is an example of what I'm talking about. You can clearly see that the price is in a downtrend, right? The price is clearly in a downtrend. And what happened? The price now goes to an area of value, which is a support level, right? This is a support level. And what happened? The sellers now push the price all the way to this point, right? And what happened? The price now went above and closes above it, right, forming a hammer. This is another example here, right? The sellers now push the price all the way to this support level, right? They push the way up to this support level, and what happened? The buyer step in and then push the price up, right? They push the price up until it forms a hammer, right? So this hammer tells you that the buyers have entered the market. It tells you that the momentum of the market have changed from selling to buying, because the market was clearly in a downtrend until it got to an area of value, right? So what happened when the price gets to an area of value? What happened is that the price got rejected. So that is why you saw this huge wick, right? You can see the rejection very long. You can see the rejection very long, right? So whenever you see something like this at a support level, you know fully well that the buyers are planning to push the price up, right? So what you simply do is you wait for this candlestick, this hammer to close for you to place a buy trade, and your stop loss will be below the support level, right? So if you watch clearly, you see that the sellers push the price down, right, to this point, and the buyer step in and push it all the way to this point, and the price close, forming a hammer. So once the price close and form a hammer, what you simply do is to place a buy trade, and your stop loss will be below the support level. The same thing applicable here, right? Because this is clearly a support level. The price now went up to this point and then came back again to test the support level, right? You can clearly see that the price now tested the support level, and then what happened? The buyer step in again and then push the price up, right, away from the support level, and the price ended up forming this hammer, right? This tells you that the buyers are still active in the market. So what you do is you simply wait for this candlestick to close and form this hammer. Then you place your buy trade and your stop loss below the support level. Then your take profit can be at the previous high, or you can measure 1 to 3 or 1 to 2 risk reward ratio. So this is how simple you trade the candlestick pattern. This is another example. You can clearly see that the market was clearly in a downtrend. You can see the momentum of the market is down. You can see how the sellers are pushing the price down until the price got to this low. This low now acts as a support level, right? So when the price got to this low, what happened? The buyers now step in and then push the price all the way to this point, right? You can clearly see that the market opened here and the sellers pushed the price down to this low, right? And what happened? The buyers now step in and then push the price up till the price closed above here, forming a hammer. So once you identify a hammer at a support level, that is a high probability trading setup. You simply wait for the price to close and then you place your buy trade, and your stop loss will be below the support level, right? And then your take profit can be 1 to 3 risk reward, or you can wait for another resistance level for you to take your profit. So this is how simple you trade the candlestick pattern. And like I said, the bullish engulfing pattern and the hammer, they work almost the same, just that you identify them at a different time frame. And like I say, you can identify the hammer at a higher time frame. For example, at a 4-hour time frame, you can identify the hammer, while at a 1-hour time frame you can identify the bullish engulfing pattern. The hammer is a 1 candlestick pattern, while the bullish engulfing pattern is a 2 candlestick pattern, right? So that is why you can simply identify the hammer at a higher time frame, like the 4-hour time frame, and then you identify the bullish engulfing pattern at a lower time frame, like the 1-hour time frame. So my advice to you guys is to go and backtest this at your demo account. Backtest it very well to see how it works. Like I said, the hammer, the bullish engulfing pattern, both work very well at an area of value. Once you identify them at an area of value, that is when it becomes more reliable. So my advice to you guys is to go and backtest this strategy at a demo account, and let's see how it works. Backtest it very well, and once you confirm that it's working very well for you, then you can now implement it in a live account. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be notified whenever I publish new content. I will see you again in my next update. Enjoy the rest of your day. Bye.